If you had bought an average house in 1996, 11 years later it would have increased by 258%. After the credit crunch, there was widespread pessimism and stagnant wages. But it didn't stop house prices rising by 83% over the next 10 years. In the past 50 years, UK house prices have risen by 3,000%. If you're going on past trends, British house prices seem like a one-way bet. Even when interest rates went through the roof in 2022 and 23, the housing correction was less than expected. It seems that average house prices defied gravity and maintained their value. But given that affordability is genuinely stretched and beyond the reach of many first-time buyers, how is it possible that house prices keep rising? The recent rise in interest rates made mortgage repayments much more expensive, giving first-time buyers a twin problem: very high deposits and then high monthly mortgage repayments on top of that, kind of the worst of both worlds. It was levels of repayments reminiscent of past house price crashes. Yet, give or take a few percent, average house prices have maintained their value. Now, it is true there's a regional effect, with prices in London marginally falling and Scotland and Northern Ireland seeing the fastest house price growth. And this reflects how interest rates have a much bigger effect where house prices are already expensive. But when explaining recent house price trends, it's important to look at the role of wealth in propping up prices. In recent years, there's been a significant increase in the amount of parental wealth coming onto the market. Last year, the Bank of Mum and Dad gave a record £9.4 billion, more than double what it was 5 years ago. 57% of those entering the property market do so with help from their parents. And the interesting thing is that housing affordability has worsened and housing has become more expensive. Wealthy homeowners have given more to help their children get a deposit and get on the property ladder. The Bank of Mum and Dad is really a big player. It's almost like parents think, what do I need to do to help my children get a house? And it raises a question, why are parents doing so much to help their children? Firstly, the only thing to rise faster than house prices in recent years is rents. This is causing a record number of young people to be financially distressed or end up having to live with their parents. So maybe some parents think that a help with a deposit is a small price to pay to get rid of their troublesome children. It's not all altruism. But the broken nature of a UK rented sector is a factor in encouraging people to try and pay ever higher income multiples. And this is the irony of the housing market at the moment. As household wealth increases, this wealth is then used to inflate the housing market. In recent years, the UK has seen wealth grow faster than incomes, and 50% of UK wealth is tied up in the household sector, unlike the US where it's just 24%. The situation also creates inequality. Whether your parents own a house or not very important for determining the likelihood you can buy. Higher interest rates have led to lower mortgage lending, but they've not deterred family help. And this explains why house price to income ratios are not far off record levels. They have come down a little bit, but are still very high by historic levels. However, could parents become reluctant to keep propping up house prices? Not everyone can access family wealth. And if you have a median income, student debt, and are paying market rents, it's very hard to save for a deposit and buy a house. Also, the withdrawal of Help to Buy is another factor reducing demand. And there are still good metrics which suggest that house prices are overvalued, at least by long-term trends. So there may not be a dramatic crash in prices, but there are very real constraints to future house price booms. Buy-to-let investment looks less attractive in an era of tight regulation and also with a much less prospect of capital gains. But perhaps the most important factor is that real wage growth has slowed down dramatically in the past 14 years. And if this continues, as is probably the case, then it will be an important factor in limiting house price growth. Real wages are actually one of the biggest factors determining house prices in the long term. Also, another important thing is that when we talk about the house price boom of the past 14 years, it's also a little misleading. Certainly house prices rose faster than incomes post-2009. But if we take into account inflation, the real value of housing looks much less impressive. Real house prices are actually still lower than 2007. They are around 12% down on 2022. The interesting thing about UK house prices is that the period 1960 to 2007 was an anomaly in terms of very significant rise in real house prices. And in the future, it's very hard to see any continued increase in real house prices, at least what we saw in the past few decades. Even accounting for the role of wealth, 50% of the population at least still rely on borrowing affordability requirements. Now, in the short term, there is an element of good news for home buyers. Inflation has been falling this year, and even stubborn inflation like core inflation and services is falling too. And this enables the prospect of some modest interest rate cuts to come. Now, at the moment, predictions are still fairly limited. Interest rates are estimated to stabilise around, say, 4%. But even a modest cut from 5 to 4% would enable a few more people to come back into the housing market. And so far in 2024, Zoopla report a 14% increase in the number of stock of housing for sale. But at the same time, demand has increased by 20%. It's kind of rebounded from the stagnation we saw last year. And so far, 2023 has seen a 23% rebound in sales. Now, it's nothing like a boom, more like a welcome break from the ultra-low transactions of last year. But it's a sign there's a degree of normalcy returning to the market. What do experts predict for long-term house price trends? The ONS predict property price increases of around 4% in the coming years. Though last year they were predicting a 10% fall, which has not yet materialised. Savills forecast that house prices will rise 28% by 2028. This is a real house price increase of around 2% a year, suggesting no improvement in affordability if this prediction proves to be the case. What about the case for a significant house price falls? Last year there appeared to be quite a few good reasons to suggest this could happen. Interest rates increased from 0.5 to 5.2, really increasing mortgage costs. At one point, with inflation exceeding expectations, mortgage rates rose to over 6%. Combined with record housing unaffordability, the weak economy, it all seemed the perfect recipe for house prices to fall. And also, it is worth bearing in mind that historically, when interest rates go up, there tends to be a time lag of maybe 24 months before house prices start to fall. In the 90s, prices fell 2 years after interest rates started to rise, and a similar thing in 2009. Now, this year, still many homeowners are remortgaging to higher interest rates. The effective rate on outstanding mortgages has risen from 2.5 to 3.7%, and this will continue to rise as more homeowners remortgage to higher rates. However, given the performance of the housing market this year, combined with better news on inflation and interest rates, it's hard to see any imminent crash. New mortgage lending rules, which were brought in post the financial crisis, means that fewer households are exposed by the rising interest rates. And unless there's a big recession with rising unemployment, we're unlikely to see the kind of repossession rates we saw in the early 90s and to a lesser extent 2008. For all the weaknesses in the UK economy, and there are some still very real weaknesses, unemployment is low, and we've started to see some tentative signs of real wage growth. A housing crash would really need some kind of black swan event, such as an inflation shock like 2022, or financial market turmoil like we saw in 2008. Now, given the geopolitical uncertainty, this definitely remains a realistic possibility. Also, the signs of the US economy slowing down and turmoil in stock markets and financial markets could spill over into the housing market like 2008. The government plan to build 1.5 million new homes in the next 5 years. Will this alter prices? Well, it will a little bit, but not that much. As a rough rule of thumb, if you increase supply 1%, prices will be 1% lower than otherwise. So if you build 1.5 million homes, it will limit price rises, but not a huge effect. Also, I think that it's worth pointing out that meeting housing targets will probably prove very difficult. Certainly the past record is pretty poor, and house builders are showing lower profit margins, and they claim it's hard to get skilled labour and build houses in the first place. An interesting development of this year is that the fastest house price growth has come in those areas which are least expensive, where there's greater affordability. Prices are rising faster in Wales, Scotland and Northern Ireland. Perhaps a continued trend to working from home could rebalance prices throughout the country, although to be honest I doubt that. 33% of all graduate jobs are still in London, and that's where most of the demand will continue to be. How much is immigration affecting house prices? Again, there's some upward pressure from a rising population, but it's not a fundamental factor. It influences prices, but not very much. Now, certainly very high levels of migration in the past 2 years have put upward pressure on rents, and this has some spillover effects into house prices. Recent migrants are much more likely to be in the private rented sector. They very rarely buy when they first come here. But also, I'm a bit sceptical of the predictions of massive increases in the population. I've made a video on this you can check out later. The UK has falling fertility much faster than the ONS admit, and in the long term the population rise may be less than the ONS forecast. It's worth bearing in mind the case of Japan, where house prices are still below their 1980s peak, at least partly due to demographic factors. Should the future of house prices affect whether I buy or rent? Well, I think there's a general rule that you buy a house if you can afford the mortgage repayments and it makes sense compared to the alternative. And I wouldn't worry about what may happen to the trajectory of house prices, whether they go up or go down. For investors, buying on an interest-only mortgage is certainly less attractive than it was 10-20 years ago. Since 2000, most investor profit came from capital gains, but it's hard to see any real house price gains in the coming decade. It's always difficult to predict what's going to happen to house prices, but one thing is definitely true, is that the current younger generation have really been failed by the current housing market. This video goes into more detail about why it's so difficult for so many young people.